Hello and welcome. Today we have a special guest. We have Andrew Saks from LeapRate website here with us. Andrew, I would love to hear from you. What is the topic that we're going to focus on today?
Today we're going to continue talking about something which the whole Forex industry has been discussing over the last month and a half. But we're going to focus on specific aspects of the internal discussions between industry participants, liquidity providers, prime brokerages and retail brokerages, as well as their technological partners, as to how they are adapting their business models, or even considering adapting their business models, to in the aftermath of the removal of the peg against the euro by the Swiss National Bank on January the 15th.
Which caused a major shock in the market. As we know, the Swiss bank that decided not to be connected anymore to the European market right now is independent. It doesn't have any bottom line, which was 1.20, right?
It was indeed.
That trade between the two currencies.
1.20, that's right.
So how we can see this action by the Swiss central bank cause right now any movements in the markets?
Well, now mostly the extreme volatility that ensued in January on that very same day has gone away, of course, because it was an instant matter.
The Swiss franc volatility?
Yes,
okay.
It appreciated rapidly.
Wow, amazing.
Once they took the peg away. And it caused many Forex brokerages to find themselves in a situation where they had negative client balances.
Because nobody predicted it.
Nobody predicted it, and they were also, if you look back at how the retail sector has become over the last few years, what's happened is that retail brokerages have, over the last 3 or 4 years, emulated institutional trading desks in their business model. So that comes right the way down from the liquidity provider to the prime brokerages to the technology that aggregates the liquidity often through a liquidity bridge solution into the broker's MetaTrader platform. And as they've emulated this institutional model, traders and brokerages have all gone down have tried to look at providing what they call an A-book order flow, which is where no trades are internalized by the broker. All order flow is passed to the liquidity provider through the liquidity bridge, and then the liquidity provider or prime broker uses an aggregated liquidity feed and sends it all out to the live market. And you get a price instantaneously, and the spread is very, very low. Mm-hmm. They're all concentrating on that. Many introducers of business were concentrating on how to choose the specific broker they would send their business to that has the very, very lowest spread on the majors and very quick execution. But what was not being considered was the potential risk if something like what happened on January the 15th actually was brought into effect. And it caused, what happens then is that everyone's very happy because they've got
everybody is very happy.
Before that, they've got low spread,
exactly.
They have instant execution, they believe that they are not part of a dealing desk system, so nobody is trading against their own trades and they're operating in a live market. But they're not prepared for a system an event like that where if you have no internalization of orders, the brokerage transfers the order doesn't get filled because immediately one currency rapidly appreciates against the other, the peg is removed, the whole parameters are changed.
And you also saw the euro crash in the same day.
Yes, absolutely. Yes. And this is the thing, as we discussed previously, the Swiss franc, the Swiss National Bank was safeguarding itself against the potential European Union problems that are being compounded by Greek debt. So it did that, safeguard itself. This immediately made very, very bearish sentiment on euro, and as a result, the price of the franc appreciated, price of the euro depreciated. Huge differences in one day. Orders were being transferred. If you look at the actual steps that an order has to go through, it comes from the trading platform through the liquidity bridge to the prime brokerage to the liquidity providers, which may well be an aggregator or it might be banks. So then, at that point, those orders are being transferred out of the company. The bank fills the orders, or the liquidity aggregator fills the orders. Then there's a big negative balance on the client's accounts because of this. So then,
because many brokers actually got broken.
They did.
Lost all the money. Yes,
they did. And then what happens then is that very same day, or within a very short time, where the order is being executed will contact the brokerage and say, now you've got a debt of $300 million.
Wow.
You must clear that immediately. Otherwise, that's an insolvent situation.
So how can they recover right now?
Well, they either have to transfer that across, and then that makes the brokerage insolvent, or they expose their clients in that to negative balances. Now, this is called into question the whole execution model. If you go back 3 or 4 years ago, many forex brokerages were based around the MetaTrader 4 platform. The MetaTrader 4 platform was designed purely and primarily to be a system which gets provided to a brokerage and all trades are internalized. Nothing is passed to the liquidity provider. It was designed with that model in mind. Fixed spreads, no integral dealing desk system. So you have dealers on one side making the market and traders on the other. And that was the whole design of it. Of course, traders moved away from that idea. Once retail forex became more popular worldwide, they wanted the fixed spread removed, and they wanted to have an A-book system, which is all very well, but now we're seeing a downside of it, and liquidity providers, technology companies that provide risk management for liquidity bridges, and liquidity aggregators are all starting to question whether they should go to a hybrid model which combines a system where it follows the real market. They transfer trades to their liquidity aggregators, but they also have a system where they can B-book some of the trades. Mm-hmm. This may have mitigated some of the thing. We talked about this in panels at industry conferences recently. We've seen many A-book liquidity providers wanting to do this. But I think it's important to actually talk, because this is such a poignant subject, it's very important that we actually should talk to those from within the industry who operate this and provide liquidity.
Oh, that can be great. Do we have some guests today?
We do. We'd like to speak to Paul Orford, who's the Vice President of Business Development at Top FX in Cyprus.
Today we have a special guest, and you wanted to say something.
Yes. We talked about, prior to the break, we talked about the run-up to the Swiss bank having removed the 120 peg.
In Jan 15, of course, yes, the major shock in the market.
Exactly. And then, now, after that's happened, how this has caused brokerages, technology providers, liquidity companies, aggregators, and the whole execution stack and every aspect that's included in that to rethink their business model right the way through from beginning to end. And
so this is our topic for today. This is a subject we're going to talk about, and you prepared for us a special guest for today. We have Paul Orford with us. Paul, how are you?
I'm very good. Yourself?
I'm great. So, Andrew, please present Paul and explain to us what are we going to talk about
Absolutely.
With Paul today.
Paul is the Vice President of Business Development at Top FX in Cyprus, which is a prime brokerage that provides prime brokerage and liquidity solutions to retail forex brokers around the world. And Paul and I have, over the last few months, talked at length about this particular subject, about the liquidity providers and the aggregators and how they should perhaps rethink their business model in such a way that it provides good execution and also good risk management, because of exactly as we spoke before the break, many brokerage went down the route of taking A-book liquidity to their clients, which the clients wanted, and this has become very much a de facto way of doing business now. But since the January the 15th events, it has become slightly problematic in that it exposed clients' negative balances, and now some companies are looking at doing a hybrid combination as we talk. So really wanted to talk to Paul about how he sees from inside the industry itself the liquidity model changing, and how a product can be made in such a way that its execution is fast enough to make it a class leader, but also gives it so that gives a service that doesn't expose so much negative balances in events like this.
Okay, so Paul, we would love to hear your inside view on what is right now happening after January 15 event.
Okay, well, January the 15th, I think, will go down as one of them dates in history where it really was, to use the American phrase, a game changer. The landscape, when we look at it in the next year, is going to be so radically different that I do believe that there's going to be a lot of changes in the industry with regards to the company names. I do believe that clients still actually love STP when they come to us, like the brokerages or the HFT traders, for example, they still believe in the model. Okay. With regards to the negative balances and things like this, I believe that is more down to the terms and conditions of the actual brokerage, where this affected the client base. You know, it's not down to STP in itself. Okay, they're exposed to the negative balance, but when it comes down to the clients actually having to pay for this, that's more down to the brokerage themselves. Okay, so since the actual January 15th happened, we saw an advent of people claiming business as usual, so on and so forth. Things are great, but we did actually see a marked increase in people coming to us with regards to wanting to know more about the actual XTP execution. Because if I'm a client, a trader, and I'm with a brokerage, me personally, I believe that the STP model is the ethical way of doing things, because you know you're all pulling in the same way. You know, as the client, the brokerage, everybody has the same goal of looking to offer, of not trading against the client. You see, with the market maker model, you know, sometimes it can be a little murky, so to speak. I mean, I know Andrew's had a number of opinions on this himself as well, but I'd like to hear what he thinks about that as well.
Well, I think that's certainly right, and it's a question of the difficulty is, from the prime brokerage point of view and from the liquidity provider point of view, is to keep both sides an equilibrium between both sides, because there was a time when it's gone through three major changes. This whole side of the business. First of all, about 5 years ago, it went from being majority of retail brokerage had the MetaTrader platform, which was connected to a internal dealing desk, all provided by MetaQuotes. The whole system was not designed to send any trades out to the external market. Now, since the A-book model has become more in, you have businesses such as Paul's business, which provides direct liquidity from the outside market into brokerages and transfers trades to the live market. So that went through, and that was
5 years ago.
But roughly 5-6 years ago, this became very popular in retail for it. It's always been, the institutional model has always worked like that.
Okay.
Then you have now this, and this was a huge success. This A-book model became a worldwide de facto way of doing business, as I said, and you have clients all around the world asking, "Are you a market maker?" And if they say, "Yes, I am," then the clients were reluctant to invest, because the way of thinking was that if a brokerage trade transfers all its trades out, then it is transparent. You're getting a real price. You can see on the MetaTrader 4 the real market price. It's tracking it through a liquidity bridge. But what was not considered was what would happen if a client was exposed to. Nobody considered that there was any possibility of being exposed to negative balances.
We had right now.
We had right now. So now we have some companies didn't survive.
But could I ask you something? Even in B-book, the traders can be exposed to a negative balance. It doesn't matter whether it's E-book or A-book.
It depends how they do. I mean, Paul will know really how to look at that, because B-book is kind of we have to make sure that we stop getting execution model wrong.
Yes, but
it's really a question of whether B-book will scare off all clients because they will worry about trading against the dealing desk trading against. Paul knows, you see brokerages every day and you see all of their retail execution models, so you're really somebody who knows that from the inside out.
Yeah, well, one thing which I kind of see, I think we're going to see in the next year, maybe 18 months, people changing platforms as well, perhaps, because if the brokerage is going to use the hybrid model, then I've only had a basic look at this. So I know that Spotware have some very interesting products coming out with regards to a very niche type of market. Okay, if you're going to be going down the STP route, me personally, I would be looking at something like this. It's kind of more fitting with that type of model as opposed to other platforms that I've seen. Now, one thing which I found interesting was, I know it's a lot of ifs and buts and various kind of scenarios which may have happened, but let's say, for example, that the January the 15th, the trade went the other way. You would have had...
What do you mean the other way?
You would have had carnage with like B-book model or the market maker model, where the clients would have been on the other side of the trade, perhaps.
Like you said, Jaron.
Yeah, I want to present things from the trader's perspective in order to understand how the system is working and what is the benefit of the traders as well. So as a professional trader, I can tell you that I don't care who is in the other side of my trade. It doesn't matter whether it's ECN, it doesn't matter if it's the broker, it doesn't matter at all for me. Because I know what I'm doing, I know how to manage my money, and if I'm a good trader or professional trader and I know how to manage my money, it doesn't matter so much from the trader side. There are some I can tell you that it doesn't matter the spread is, if the spread is too tight or a bit tighter, it doesn't matter so much. As long as I'm getting a clean execution process, and as long as I'm not getting any requotes or any delays in my execution, it's fine with me. I don't care. As a trader,
that I agree with on an individual basis. If you're an experienced trader like you, then that's different. But let's say you are a retail brokerage and your mission is to get as many new clients as possible, and it's very hard. It's getting increasingly hard to get new clients. Very expensive, $800-900 per acquisition nowadays.
Yes.
And the clients are coming to you from places like China. They're not experienced, but what you're relying on is the introducing broker to bring them to the retail brokerage, who then the retail brokerage in turn transfers the order flow to the liquidity provider. They are looking for as many clients as possible in one go. And if the introducing broker finds that there's any booking, they might not do it because the client, it's a huge amount of clients that will be booked, and then we'll have problems. And then finding the same level, let's say each introducing broker brings 20 or 30 clients in one go from a different region, like Asia Pacific or something like that. Replacing those clients will not only be very expensive, but I'm sure you'll agree, Paul, a long drawn out affair.
No, I agree. You bring up some very interesting points with regards to the clients, and they don't care about this. That's very much in the perfect world, where everybody is playing it straight back, so to speak.
That's right, exactly.
Like, what you have to remember with the B-book model is when the client wins, the brokerage loses.
Mm-hmm.
What I've seen, they're not charitable institutions.
That's right.
They need to make money themselves. So, by all means, if you find a B-book brokerage, and there are many who offer good execution, ethical trading conditions, fast withdrawals, etc. I'm never going to say there isn't. However, I think you kind of live in a world where you assume that everybody plays in an ethical type fashion. Sometimes that doesn't happen in Forex. This is what we only have to read, like LeapRate, where Andrew writes about it, for example, other publications as well, where clients will tell you there's discrepancies with their trading, the way they're treated. They can see that they've won a trade, for example, and they can't close the trade. There's a million different ways.
We have as Paul says, we have our broker complaints section, which is a section within LeapRate, and there are usually patterns between complaints, and some of those complaints in the past have been that B-book brokerages, some of them, especially if they're not regulated and they're not answerable to anybody, will do various things, like they will withhold client funds and then hope that the client will trade instead of giving them a withdrawal, and at that point they will then widen the spreads, interfere with the execution models. Correct. And you can't do that if you're an A-book, but what you can do, if you're an A-book, then it's much more in terms of the execution is much more, nobody can interfere with it. But if an event like this happens, you can end up liable for losses.
Correct.
Guys, we need some more time for a second topic for today. Any last words that you want to add? Paul, let's start with you. Anything else that you want to add on this topic?
Well, I'm just going to be interested to see how the landscape is in 12 to 18 months. I think it's going to be radically different. Mm-hmm. I think, although people, they may claim they've fallen out of love with STP, it's going to come back in a big way, very big way, in my personal opinion. Like we discussed before, with the B-book, let's say that the trade went the other way. We would have had complete carnage with B-books, especially where I am in Cyprus. So I know it's counterfactual, but I still believe there's a huge market for STP, which we will see too.
Great, thank you, Paul. Andrew, any last words?
I would agree with Paul, and I think that there are two. Bear in mind that it's very, very interesting to hear that Paul's saying that is seeing it from the other perspective, seeing it from the liquidity provider's point of view, and seeing it from a best practice and risk management point of view. We're also seeing that I would agree that there is a way that it will go back to STP and to A-book, but I think that some companies will start registering with their regulator to be able to do a hybrid model between to combine A and B book together, so that they can majority of the time run an A book, and if they see something like what happened on January the 15th, they can switch quickly to a B book model and mitigate any risk against clients. And I think that will engender a lot more faith in brokerages, technology companies, bridge providers, and of course end users.
And that will be a safer field.
Yes.
Exactly. Jeroen, any last words you want to add?
Yes, I agree with both of them. I think that we are going to see a hybrid model dominating in the market, of course, but I think that it's only fine-tuning of the brokerage technology, and it's going to be all about marketing. The marketing will be the game changer. The marketing will have to improve, and they will have to find new ways in order to market the products or the platforms. This is the most significant change that we are going to see in the market. I think that the approach of the marketing component is going to change dramatically.
Yeah.
Okay, so Paul, thank you for joining us today from Cyprus. It looks like you have a great weather.
Can I just reply to that question and answer very briefly?
Okay, you may, yes.
I'll be very brief. I understand you're on a time limit.
Sorry.
With regards to STP, I've always believed that you're going to save on your marketing, because you're going the same way as your client. Therefore, you want the client to do the best they possibly can do. Okay. With regards to the B-book model, the only way the brokerage can make money is by the client losing. Therefore, the client's going to get disenchanted with your service, and you have to bring fresh clients on. Yeah. So to my logic, it just says to me that if you have an STP model, the brokerage is only making money from the volume. You're only going to give the best to your client anyway. And from that, the client's going to be the best advertisement ever by telling their friends, colleagues, business associates that this company is giving you great execution, they treated you well, because everybody is pointing in the same direction. It's the client's success. You can't guarantee they're going to make money, but you can give them the best service so they've got the best shot at doing that. With a market maker, can you do that? I don't know. I don't think so.
Especially in regions like South America and Latin America and Asia Pacific, where they really have all these forums and word of mouth, whether it's word of mouth introducing broker to client or word of mouth forums, it is hugely important.
Yes.
Yeah.
Okay, thank you very much, Paul. And it's been a pleasure. Thank you.
See you soon, Paul. All the best.
Thanks.
Okay.
Bye-bye.
Bye-bye, Paul. Right now, we're going to take a short break. When we come back, we're going to hear from Andrew what is the next topic that we're going to talk about.
The next topic continues on the sort of risk management theme, but through a different principle. Not the risk management of trades, but risk management of payments. How to transfer payments to and from brokerages without risk of hacking and fraud when funds are held within a brokerage account.
Okay, so it's going to be very interesting. Few minutes and we're back. Stay tuned. We're continuing today with Andrew Saks from LeapRate, and now we're going to talk about today's second topic. What is the second topic for today, Andrew?
Well, the second topic is that continuing again along the risk management lines, but with a very much a technological accent on it this time. Many brokerages have really reopened the whole risk management question since January the 15th, and now we're looking at different...
After what happened, of course, with the Swiss, with FREED and the European markets, yes.
That's right. So that has made a whole conundrum about risk management to be reopened, and for brokerages and technology providers to look at how to resolve situations like exposure to negative balances in the event that should what they call a black swan ever happen again. But
there's a nickname for January 15, the Black Swan.
There is Black Swan, yeah.
I didn't know that.
A Black Swan is an event usually in financial markets or government or politics, geopolitics, which is an unprecedented, unexpected, sudden event that causes the whole ecosystem to be turned upside down. So it's not, you're going along normally, everything's normal, all the brokerages and technology providers providing order flow as normal. Then along comes this removal of the Swiss, the peg against the euro, and everything is turned upside down immediately, which calls into question the whole business model of pretty much the entire industry. That is effectively what a black swan is.
And that is exactly what we're talking about right now, the effects of this black swan.
The effects of that black swan. So that's what everybody's focusing on at the moment. And we spoke to Paul Orford from Top FX about it. I spoke in Mexico City 2 weeks ago with some senior executives of British liquidity providers who are looking to go into the Latin American market. They've already done very well in China and the Far East. Now they're looking at other emerging markets. But one of the main topics on the agenda was how to provide technology and liquidity and prime brokerage solutions to brokerages in new markets.
To avoid these kind of situations.
Kind of thing. They're starting from scratch in an area where it's totally new, and they're now looking at how to do that in a way which will make sure that they can provide best execution, but without any exposure to black swans, if you can call it that. So what's been perhaps ignored over the last few months, because the whole industry's attention has been concentrating on how to do that,
and how to recover
from it, and how to recover lost funds and negative balances, but also regulatory and technological companies are looking at safeguarding client funds. So you have, what happens is, as you know, you transfer. When a brokerage retains a client, they transfer their deposit into the brokerage, which holds it in a segregated account. It's all done electronically.
Okay.
There's a specific electronic process that operates it. And there has been a lot of companies nowadays which have founded themselves to provide algorithmic payment systems which facilitate the transfer of funds from a client account, for a client's bank account, into a brokerage account. And some of them are designed in a way that it mitigates cost and risk from international transfers. If you're a client in China and you want to transfer funds to a brokerage in Cyprus or in Britain,
so you can do it using the internet,
because China is a communist country and they block they have their own system for everything. You have Chinese systems for everything, but you're not allowed to use the outside ones.
So of course, how can you do it as a Chinese trader?
As a Chinese trader, you have to use. You can use a credit card, but ultimately, or a bank transfer, ultimately they're not allowed. The gateway somewhere will stop it and send it back to the customer, because China is not a free market economy. They have capital control laws. So companies make algorithmic systems which circumvent that in a way that it will allow clients to send their funds abroad to brokerages. But something that's been ignored, and something that was highlighted to me by the CEO and founder of a specific company in Britain which actually manufactures payment solutions for Forex brokerages, among other businesses, but they do have a lot of Forex brokerages and Forex companies as customers. What would happen if you've got what happens on the way to the brokerage account and on the way out of the brokerage account? How secure is that? Okay. As far as hacking is concerned, Trojan horse viruses.
And I'm assuming there have been some hacking attacks.
Yes, there have, because the whole focus has been on risk management. What does a client look for? They look for whether they're going to have their funds used, misappropriated by a brokerage. So whether the regulator in the jurisdiction that they are based in is strong enough to require good quality net capital asset regulations, like the US, where if you want to be a US retail Forex brokerage, you've got to have 20 million in net capital set aside that you're not allowed to touch or use for business operations, because it has to cover any possibilities of if the brokerage makes an error and they have a problem, they have to be able to cover that cost back to the client. If they don't, they face a lawsuit by the CFTC. So Australia has 1 million, Britain has 1 million. Most of them have enough to cover should something happen to a client, a complaint arises, or a compliance inspection comes and a complaint arises from the regulator.
But how this kind of connection can be influenced, like events that happens January 15?
Let's say you've got a retail Forex brokerage and it's not in a jurisdiction which keeps net capital aside that cannot be used for any operational purposes. Then if a brokerage goes insolvent and that capital is all part of the brokerage, then that's it, and then the clients are left with no, or either that, or the net capital is not enough to cover the vast net negative equity that comes back. So that's one thing.
But this can happen the same if I will come to my brokerage and will pay him, right? I mean in the place, and not paying him using the internet connection.
Right, absolutely. But everyone's focusing on that. When you're a client, if retail clients are saying, well, where's my funds being kept? And are they being held safe in that brokerage? And what if this happens? What if the negative equity happens? What if your company fails and you misappropriate my funds? What they don't consider is what happens when they make their transaction on the internet, where it goes before it reaches there and where it comes out. Now, I spoke in detail last week to Tim Thompson, who's the CEO of Noir in London, which is a payment processing company, and he was effectively saying that the whole risk management model has to be looked at in terms of how to mitigate hacking and access to customer accounts and FX brokerage accounts by fraudsters when the money is on its way to and from them. And Tim actually really looks through all the forums and is actually saying that this is becoming a big subject of discussion among retail investors at the moment.
We have maybe a chance to talk with Tim right now.
We may have, yes.
We'll check it out. I'll tell you what.
We will.
We're going to take a very, very, very short break, 1 minute break. When we come back, we'll check out if we'll be able to talk with Tim. So a few minutes, 1 minute actually, and we're back. Stay tuned. Hello and welcome back. Andrew, let's continue where we stopped. Please present again the topic that we're talking about.
Certainly, we're talking about the potential threats from hackers and internet fraudsters on funds transferred by clients through automated payment systems to and from retail forex brokerages.
And we mentioned that what happened January 15, which we call the Black Swan, had an influence on this kind of a connection. What has changed since since January 15th?
Well, I think that there's always been a threat from hackers, and that's why some of these algorithmic payment companies have now been so successful. You've seen last year SafeCharge, which is a very large now publicly traded payment processing company, which provides payment processing services to forex brokerages, developed an algorithmic system of how to transfer funds securely and without any risk, as well as being able to circumvent certain capital control laws in some jurisdictions to make international payments to forex companies very, very easy. Now, that company did an IPO last year for $126 million.
Wow.
On the London Stock Exchange. Israeli company.
Really?
Yeah. And IPO'd and went public on the London Stock Exchange's alternative investment market last year. This is how much in demand these kind of specialist technology companies are that provide payment services because it's purely online business, and they have to be quick, secure, and no risk no risk from the outside, from fraudsters and so forth. So the events that we talked about that happened recently on January the 15th has taken the attention away from safeguarding of transactions. What is focused everybody's mind on is liquidity, provision, execution model, and how to safeguard from a client's point of view, how their funds are safe within a broker.
Because as we know, many traders have been influenced and have been damaged by the last recent
So
event.
they're worrying about, the retail clients are worrying about what happens to their funds once it's actually in the custody of that particular broker, in case their risk management model allows them to be exposed. What it's done is taken the focus away from what happens on the way to and from when you make a deposit or withdrawal. Now, as I said, as I previously mentioned, I spoke last week in detail to Tim Thompson, CEO of NoirPay in London, and he's been looking at the forums and what's being discussed on international forums.
Oh, that is interesting. Okay.
Which is really interesting because with everybody else's attention away from it in the forex industry, Tim's business is to look at this particular type of technology and how to refine it and how to ensure risk management between the merchant services provider, which is usually Visa or MasterCard or American Express. That's very rare, mostly Visa or MasterCard. And what their criteria is, as well as how to provide forex brokers with an easy system to get as much clients as possible to be able to bring their funds across. But on the way, so he's looking now at what is being discussed on forums about phishing, which is the process of fraudsters and criminals looking for specific data on the internet that they can actually attack and use. They can intercept it and use it for their own purposes, therefore theoretically do a withdrawal for themselves or steal from the merchant service provider. They're also looking at Trojan malware programs, and that this is something which is becoming a very big, major concern among potential retail investors around the world.
Why is that?
Mainly because what's been happening is that it's been taken too lightly that your funds are safe just because you're going to be investing with a regulated brokerage who can protect you if something goes wrong.
But if you lose an investment, if some major event happens in the market, as we saw the last scenario by the Swiss central bank, how can you protect traders from these kind of events?
Well, you can't. But what I'm talking about here is that before we even get to that, the client is looking at, there's just been this thing that happened with the Swiss franc. Now I've read everywhere on all these forums that there's negative balances and some brokerages have either folded or the ones that haven't, some of them are going after clients, some of the bigger clients for negative balances. They won't go after the smaller ones, but they'll go after the big institutional traders for some of that. Then they're looking at that and saying, where's it regulated? Have I got any recourse? Something goes wrong. What they're not looking at is what happens when then they'll just make the deposit. Okay, my funds are safe in there. But what if, on the way to that, through the payment system, there's a hacker or there is phishing or Trojan malware. This whole brokerage system of where your funds are being kept has taken everybody's attention away from that. So now, as a result, fraudsters and hackers are capitalizing on that and are gaining lists of client logins and password details, and they are trawling through them and then logging in and out of accounts to check balances, and they're actually succeeding in doing so. And actually, Tim was explaining to me that he has quite clearly seen that most of the forum discussions between retail investors are saying that there's been a large number of client lists that have been able to be obtained from brokerages without much difficulty, actually, which is quite worrying because they will go in, they can check the balances, they can then operate them themselves, and they've got control of it. So then they're logging out. What's the problem is that brokerages are looking at how to safeguard themselves against risk. They're looking at, like we've just discussed, the A-book versus B-book model, how to improve their risk management system within the order flow system. But what's happened is that they're not necessarily looking at the payment process between the clients depositing and the funds arriving in the brokerage, and between sending the funds out and then using the payments services provider to send it back to the merchant services company. So what's happened is that the logging in and out of accounts by fraudsters is quite detectable. It's just that nobody's doing it.
Why is that?
Well, they're not aware that this is something that's so easy to get hold of.
Exactly.
So, for example, brokers often check IP addresses. They often look. I've seen that myself. There are many systems which you can buy as part of the CRM that most brokers use. You can see the IP address of where the origin of the client came from. These can actually be tumbled by the fraudsters every single time by using a proxy server to give the IP address in the country where they want to appear. The fraudster then narrows down the list of accounts to hit, goes back a few weeks later, and then possibly makes a withdrawal quite successfully.
Wow. So right now, we're talking about what's happening right now after the event.
That can actually happen. That is something that can quite clearly happen and has been
So how can we defend our traders for this kind of scenario?
Well, there has to be greater security and coding inside the system which is used by payment processing providers to transfer funds to and from the merchant service provider. I'm sure that MasterCard and Visa use these algorithms within their own system, because it is very, very rare now for somebody to access a system inside a credit card payments.
Very good. That's good news for the traders.
Very good. But when you send your funds and it leaves the merchant services account and it's on its way to the brokerage, that particular chain of events can be hacked quite easily, and has been, according to this particular conversation that I had last week, has been the subject of hacking. And therefore, what needs to happen is that the payment processing companies that provide payment services to forex companies should look at how they can integrate risk management systems and security flags within CRMs of brokerages, rather than just provide it as an external service. And therefore, it should be able to flag up a warning and then prevent that payment. The problem
So those are the changes that we're expecting to happen in the market right now.
But the problem that they're going to face is that some brokerages don't want to put any more obstacles in the way of obtaining clients, because it's hard enough as it is. If there's a genuine client that is using a proxy server or lives in a country which has had lots of these experience with this kind of behaviour, and it stops them depositing, then the salesperson will probably give up, because then the client will say, well, it keeps coming back. Then eventually, if it goes through, they'll have to provide all this documentation and so forth, and it puts another obstacle up. So the difficulty is to make a risk management system, should be algorithmic risk management system, that allows payments through, but stops hacking from the outside, stops external hacking.
Okay, is that so complicated as it sounds?
Yes.
Oh, it's our time to wrap up. Any bottom line that you want to say before we're going to say goodbye?
I think that we are looking at now, having had this conversation last week with Tim.
That was your conversation with Tim. Okay.
Yeah, we're looking at a time where the forex brokerages, retail forex brokerages, the systems providing side of them, which gets its software and usually as a package, has got to start looking at the interaction between the back office system and the payment processor, and whether it's got any whether there can be any further developments towards stopping hackers and malware Trojan horses from the outside, because this is now becoming a next large topic in terms of internet security.
And of course, we like to talk here about the next large topics. Andrew, thank you for being with us today.
Thank you.
I'm really looking forward to what is going to be next week's topic. Thank you for joining us again. We will have Andrew next week as well. Have a lovely day. See you next week.